Welcome to Markets Radar with Jeremy Quintanilla, your home for everything markets, from stocks, bonds, crypto, and everything in between. And I break it down on what I think it all means. This is being recorded on July 28th, 2026. So the news may have changed by the time that you hear it. Make sure that you follow me on Age of Jeremy on Instagram. Also, sign up for my Dope Insights and Broadcast channel. You can also find me on other social media platforms. Come on over there. I give financial, advice, I would say. As long as it's free, the advice is okay. But I'm part of businesses such as 3T Warrior Academy, so check that out at 3twarrioracademy.com. I also own Freedom Insurance. Check that out at freedominsurancellc.com. And I also own Age of Radio, where we are the podcast network for everyone, or we have the podcast network for everyone. I am doing a webinar this weekend in regards to the benefits of joining the Age of Radio podcast network. So I would love it if you want to be a part of it. It's at 10 a.m. Arizona time. You can head on over to the Age of Radio Instagram channel, and there is a link for it in the bio, in the link tree. You can also get a link for it down in the episode description here as well, because we try to give a voice to everybody, because I believe every brand, every person has a story to tell, and I want to make sure that we help them tell that story. But to get into the news today, let's talk about the overall market itself. There's been a massive structural shift under the hood of the stock market. For months, the narrative has been simple. It's big tech and chip makers. They have been dominating, while everyone else gets left behind. But today, the game changed. A powerful market rotation is kicked into overdrive, and investors seem to be bailing out of high-profile chip makers in a big way, funneling those funds into economically sensitive and defensive industries. The Dow Jones Industrial Average surged by 1.2%, or over 400 points, powered by this defensive and cyclical rotation. Even more telling is the S&P 500's equal weighted version. By stripping out the massive market value biases of tech giants, the equal weighted index hit fresh all-time highs today, June 28th. Meanwhile, the broader S&P 500 managed a modest gain of 0.3%. But on the flip side, the tech-heavy NASDAQ 100 took a strong hit, falling 0.7%. In fact, the chip rout was so severe earlier in the session that it threatened to push the NASDAQ 100 towards a technical correction before a late day bounce cut those losses. Now we're looking into a sector level shakeout as chip makers head toward their worst calendar month since 2002. I'm going to say that again. This is the worst calendar month since 2002. After notching their best ever quarter, questions are rising about whether these astronomical valuations can hold. And in my opinion, I don't know if they can technically hold, because these things are so overvalued, because so much money has been pumping into these to get some of the players kind of like laid out. And it doesn't look like that these products themselves are going to be huge revenue drivers. One of the things that I talked about on our new wealth transfer podcast that you can watch Fridays on the Coach JV YouTube channel is that Google is poised to do really, really well in this space, because their revenue doesn't necessarily have to come from the AI. Their infrastructure, or their capital expenditure into infrastructure, their CapEx and infrastructure, it is to mainly make them better at all the things that they already do. They are an ad company. They're going to use their AI to do two things: improve their, well, probably more than two things, but the main two things is get the AI to get better at the ads that are going out to people, one, and then two, it's going to be able to allow the AI to be in the home, to interconnect the home. And I have a segment a little bit later that's going to talk more about that, because AI is definitely coming into the home. If we look at Brent crude and West Texas Intermediate, both tumbled also, with WTI dropping 5.2% to settle at $78 a barrel. This slide comes as geopolitical tensions in the Middle East begin to ease, relieving the risk premium that has kept energy prices elevated. The 5% drop in oil is a massive deal for macro markets. It immediately takes the pressure off headline energy inflation and gives the Federal Reserve some breathing room. Bond markets respond immediately. The yield on the 10-year U.S. Treasury fell 6 basis points to 4.59%, while Germany's 10-year yield fell 3 basis points to 3.10%. As Angelo Kourkafas, strategist at Edward Jones, pointed out, this energy decline strongly supports the view that the consumer price index may have peaked back in May. Assuming oil doesn't make a sudden run to new heights, the soft consumer and producer price readings we saw in June are already buying the Fed valuable time. It allows them to assess energy disruptions and inflation trends calmly over the summer, right as we digest comments from former Kansas City Fed President Thomas Hoang, who noted that a September rate hike would be very difficult. I think the rate hike is going to come. I think there's going to be a rate hike in Q4. That's my opinion. HSBC Holdings PLC strategist led by Max Kettner agreed that there's a solid fundamental backing here. They note that resilient profit growth, rebounding U.S. economic forecasts, and undemanding valuations outside of tech are keeping risk assets afloat despite a challenging broader inflation backdrop. Now, if we continue into winners, losers, and layoffs, let's go into some corporate earnings and corporate headlines where we are seeing highly divergent stories play out. First, let's look at the turnaround efforts at Boeing. The aerospace giant generated better than expected cash flows in the second quarter, probably because there's less crashes. Strong global demand for aircraft is providing a critical runway for the manufacturer as it works through years of persistent crisis. Now, that being said, I'm a huge Airbus fan, so I'll try never to fly a Boeing. That's my personal opinion, but that's something to take a look at. Maybe you want to get into the aerospace play. Over in consumer staples, which is what I'm highly investing in right now, because I do fear that we will be going into a recession. Coca-Cola is bubbling up. The company raised its full year outlook today, driven by strong demand last quarter. I buy Coca-Cola as part of my dividend strategy every week. Coke got a major boost from its sponsorship of the FIFA World Cup, proving that major international sporting events still deliver massive marketing ROI. 100% agree with that. And two, if you watch my Mercury show, we hit on something really cool that's going to be coming to the sports events arena, I guess you could think of. And EA was purchased by Jared Kushner and a Saudi private equity group. And one of the things that they're inventing is EA advertising, where you can actually use a self-service platform, go in and create advertisements for your business, and those ads will play in the video games as if they were in like a sports arena. So like if it's FIFA soccer, I forgot what the FIFA club, football club, I think is the name of the one for EA. If you're playing that game and you're doing a match or whatever, you could look on the sidelines and you could actually see your advertisement over there. That is a genius idea. And to be honest with you, I'm a little jealous that I never thought of that. Not that I would have thought of it and would have went to market with it, but that I just had never thought about that in general, that would be a cool way to advertise to people. Let's go over to the United Parcel Service, or UPS. It disappointed Wall Street this week. The shipping giant's outlook for shipping volume and profit margins underwhelmed investors. UPS is navigating a complex transition as it continues to unwind its shipping relationship with its former core partner, Amazon.com. Meanwhile, cost-cutting is the name of the game over at Visa. CEO Ryan McElney announced the firm is eliminating approximately 2,600 jobs. The goal is to maximize operational efficiency, and Visa faces increasingly intense competition in the global payments industry. All right, where I get all my news is I get it from Bloomberg's. I'm not sponsored by Bloomberg's. Bloomberg's is one of the places that I get most of my news. I love that media company, I guess, or news company. So go and get a Bloomberg subscription. Stay up to date. The other things that I recommend, if you want to get really into looking at markets and finding things to invest in, go and get a subscription to Wall Street Journal. Go and get a subscription through Wall Street Journal to their investor circle through Barron's. Okay, so I get Wall Street Journal, I get Market Watch, I get Barron's, I pay for Investor Circle, I pay for their energy newsletter. The name of the game in investing is information. The more information that you have, the more you can find stocks that are undervalued that you can start buying in. The more you can find stocks that are paying dividends that are growing over time that you can add to your dividend portfolio. You can use that cash, put it into the other appreciating assets, and you can use our Capital DR system that we talk about at 3T Warrior Academy. So if you want to know more about 3T Warrior Academy, go to Coach JV_ on Instagram. Follow him. You will learn about Capital DR, and hopefully you'll come and join us for one of his webinars for Capital DR. And also, if you're in the entertainment game and you want to be in the podcast game, or you have a podcast and you want help with growing that, nothing beats being a part of a network. So come to my webinar on Saturday, where I'm going to talk about the benefits and the strategies that we use at Age of Radio when you become part of our network. And get this, joining the network is absolutely free. We'll be right back. Before we get into some other news, I want to talk a little bit deeper into this chip maker situation. With chip makers facing their worst month since 2002, is the massive artificial intelligence investment boom officially dead, or is this just a healthy pause in a long-term bull market? This is a multi-trillion-dollar question. We have to look at the massive tension between short-term valuations and long-term corporate spending. On one hand, the skepticism is understandable. I'm skeptical on whether or not these things are going to make revenue. I think that they're going to make revenue in different avenues rather than from a direct consumer relationship. I think these AI investments from companies are to make their other products better and to make them more successful in their other ventures, as I mentioned with Google earlier. After chip makers notched their best ever quarter, investors started looking for immediate revenue monetization to justify these sky-high multiples. When that didn't appear instantly, which is also a problem in this space, is that it might take a long time for a lot of these things to produce real revenue. When you're doing in a large long-term investment, you may not see revenue and you may not see growth for 5 years or 10 years. These are long-term plays. If I think about this from Age of Radio, I'm doing a long-term play. Age of Radio has been my longest-term play of all time because I haven't been able to put all of the energy into it that I would like, and I'm starting to do that now because I'm getting money from other areas and investing heavy into it. So right now, it is such a large loss, but it's working on building its own software. It's working on getting better at their ad spend, the ad understanding. It's getting better on working on getting the sales, working on finding other podcasts while we're doing our webinars. That can take time. So some of these things can take 10, 15 years for that payback. When you think about how long Google has been putting money into Google DeepMind for it now to start to come to fruition, that's been probably about a 15 or 16 year investment. These things definitely take time in the long run. So that is something to be considering here, because again, that revenue monetization wasn't instant. And so what happened was investors started shifting rapidly into different areas. But if you look at actual corporate behavior, the physical build out of AI infrastructure, it's not stopping, it's accelerating. As I mentioned, Google, I don't know, I didn't mention in this episode, but I mentioned on the New Wealth Transfer podcast for one of my other episodes that Google is putting in like $200 billion into their infrastructure. Meta Platforms and BlackRock just announced plans to develop a massive 1 gigawatt data center complex in Texas. The cost is going to be a staggering $14 billion. This is a monumental long-term bet on the physical computing hubs required to power the AI future. So strategists are urging investors to look at this as a broadening of the market rather than a structural collapse. But a lot of the time you see these fluctuations because there are short-term and swing traders that are trying to get bumps of money fast. So they put it in, they get the pop, they pull it back, and everything comes back down. Yurick Hoffman-Bucardi at the UBS Chief Investment Office noted that while UBS remains constructive on semiconductors due to robust AI demand, this sector divergence is actually a positive sign. It proves that there are more ways to participate in market gains than through a narrow, hyper-concentrated set of AI-linked stocks. In short, the AI isn't dead, it's just needing to mature. The market is demanding that companies prove their spending in generating real world efficiencies, but the infrastructure building continues definitely. Not indefinitely, definitely. All right, let's move over to some other market news. I found this kind of surprising. I didn't know this was even happening. I didn't even think this would happen. There is a massive funding round that just crossed the tape at a company called Brady Corp. This is a company that's traditionally known as a manufacturer of signs and labels. It has officially secured the financial firepower for one of the most significant acquisitions in history. Brady just successfully sold $800 million in private placement debt. This massive bond sale, right? Private placement debt is that's a bond sale. Bonds equal mean debt, is designed to fund its pending purchase of Honeywell International's productivity solutions and service business, a division known in the industry as PSS. So Honeywell isn't 100% selling over to Brady, but this is pretty big because Honeywell looks like they're divesting out of the productivity solutions and service business and handing that over to Brady. The market has been waiting to see how Brady would structure the financing for this acquisition since they first shook hands on the $1.4 billion deal back in April. Now we have a better understanding of that. Working with BMO Capital Markets, Brady offered these private placement bonds across three different maturing ranges from 5 to 10 years. The deal is going to secure a private investment grade rating at the largest slice of the debt, a $300 million 7-year note priced at a spread of 125 basis points or 1.25 percentage points over equivalent US treasuries. Now, if we look at this, why is Brady Corp, a company famously built on physical signs and labeling products, shelling out $1.4 billion to buy a technology hardware from Honeywell? Brady has spent decades labeling the physical world, but in modern warehouses and shipping hubs, a sticker is only good as the technology that reads it. Honeywell's PSS division is the missing high-tech puzzle piece to take Brady to the next level. PSS provides a critical hardware that keeps global logistics moving, such as mobile computers, barcode scanners, and enterprise printing solutions. By acquiring PSS, Brady is transforming itself. They aren't just selling the labels on the boxes anymore. They are now owning the digital scanners, the mobile computing platforms, and the specialized printers that track those boxes across global networks. It is a massive horizontal expansion directly into the logistics infrastructure market. And the financial motivation here is incredibly clear. Honeywell's PSS division is not a speculative tech startup. It is a massive cash generating engine. In 2025 alone, the PSS business brought in $1.1 billion in revenue. For a total purchasing price of $1.4 billion, Brady is acquiring a deeply established business with a massive market share and immediate heavy hitting energy. So again, this is what you would think about as this is, if you guys have been following Coach JV or you know anything about me, we used to talk about leverage buyouts. This is essentially really a play on a leverage buyout. There is an instance, there's a piece of business that one company wants to divest out of. There is or may not have wanted to divest out of, but maybe Brady gave them a really good price tag, and Honeywell didn't think that it fit their model for the future. So they sold the specific division to Brady for the $1.4 billion, I think it was. And so with that sale to Brady, that now integrates Brady to another stream inside of the logistics business as it becomes deeper in it. So when you're thinking of like small businesses into businesses, there are pieces where you can buy businesses and integrate them or segments of a business so that then you don't have to go out and make it, right? So the whole idea behind planning and strategy behind a business is you lay out what the 5 or 10 years look like, where you want the business to be, what visions you want the business to look like. Do we have those capabilities currently? Could we invest to create that capability, or would it be less expensive for us to go out and buy that capability and integrate it into our system, which is something that I'm highly working on for not only Merlin in the background, but also for Age of Radio and for my business Q Financial. Again, because I have other owners and things like that, like other main owners for a lot of my businesses, such as 3-2 Academy of Freedom, I really don't talk a lot about the strategy behind those. But again, like I mentioned, if you want to know more about those businesses, you could follow Coach JV at CoachJV_. Okay, so let's look at how they chose to fund this specific transition, because the structure of this deal tells us a lot about the current state of corporate lending. And corporate lending is something that you're going to want to understand as you increase your understanding of investments. Because for me, like if I'm looking at this article and I'm reading it to you and I read it, is that I'm excited about this because this could be an opportunity for Brady's stock to increase. It also gives me some insight into, oh, I should go look into what Honeywell's doing, because that might be a stock that I want to add to my portfolio if it meets my overall investment thesis, because there are two big things that are happening here. Honeywell's divesting out of something, which means Honeywell might have a plan for where it wants to go into the future, which could provide a possibility for an undervalued stock. Same thing for Brady, looking at this and what Brady wants to do to become more integrated in the entire logistics of their business, right? Which I only know about from reading this article. I want to go and research that and say, oh my gosh, this stock is completely undervalued. I want to go buy it. Or if I find out these are good dividend paying stocks and I'm looking at what this is happening, I can be, oh man, this revenue is going to be great. Their profit's going to be great over the next 10, 15, 20 years. Let me go ahead and invest in these so I can get a good dividend income coming in. And that's one of the things that you want to look at when you're thinking about investing in specific companies. Now, going back to looking at this from a corporate lending perspective, instead of dealing with the scrutiny and volatility of public debt markets, Brady opened to tap the private placement market. So again, in this setup, BMO Capital Markets sold the $800 million of the directly relation to the 800 million of debt directly to large institutional investors. Okay, the $1 billion as a $1 billion term loan to other Wall Street lenders to round out the capital specific structure. So it went to institutional investors to sell it, and then it also went to Wall Street lenders to get the other $1 billion term loan. By doing this, Brady is following a highly successful corporate playbook, and the private placement market has actually seen record-breaking issuance this year, which we have talked about, because private placement or private loans have skyrocketed because it's too difficult and too not only difficult, but too what's the word I'm looking for? There's too much bureaucracy or like the government looking in on it when you're doing all of these things in the public market. Now, if Brady's a publicly traded company, right, this might be like looked at, and these also have to get looked at by the SEC as well. Like the company is held to a different standard because it's a public company. But a lot of the times when you're going through a public issuance of debt, they chose to probably do the private route because it was probably easier, and it doesn't have to maybe go through the same process of putting debt out on the open marketplace. Volatile public markets have pushed highly diverse organizations, ranging from major corporate brands to massive sport leagues, to bypass public markets entirely and sell debt directly to institutions. Brady's highly successful bond sale is again just proof that this private debt is becoming the preferred vehicle for major corporate transformations. And that's mainly, like I was trying to explain, is that because of the fact that when you're doing something to the public, there's more red tape that you have to go through and more, I'm assuming, compliance associated with it. With the $800 million bond deal priced and the $1 billion term loan syndicated, Brady has cleared a major financial hurdle. Now the market's focus shifts to execution. Integrating a massive $1.1 billion revenue business is not an easy feat, but if Brady can successfully marry its labels with Honeywell's scanning technology, they are positioned to become an absolute powerhouse again in the logistics sector. So these companies might be worth checking out. As I mentioned in the first segment of today's show, we will be talking about AI coming into the home. So let's talk about that. Today, Apple Inc. officially pushed its total market value to $5 trillion for the first time ever. Shares of the tech giant climbed as much as 1.8% to reach $342.89 in early trading. Again, this is on June 28th. The spark behind this massive valuation surge is a major, highly anticipated hardware reveal. Apple's preparing a dramatic, aggressive push into smart home market with an entirely new lineup of AI-powered devices and software. And to give you some context into this, Google is just doing the same. After 6 years, Google is also updating to introduce AI into their home speakers and pushing out a new one, which should have been at my house, I thought, last week, but it hasn't arrived yet. But according to private plans, Apple is readying a 3 prolonged hardware offense. At the center is a brand new home hub device designed to act as the command center for the modern household. Accompanying this new category are refreshed versions of Apple's existing home hardware, an updated Apple TV set, top box, and refreshed HomePod Mini. The Apple TV and HomePod Mini are scheduled to launch as early as this fall, with the marquee home hub set to follow between October and earlier this year. Now, Apple has been historically a laggard in the smart home space, with its existing speakers and TV boxes remaining relatively modest sellers. And now, can the new Siri AI assistant successfully break the dominance of Amazon's Echo and Google's Nest and Home lineup? And we have to look closely at if Apple is doing anything different. Apple's wearable and accessories division makes the vast majority of its money from AirPods and Apple Watches. It has struggled to turn home products into serious money makers, but this new push is different because it is built entirely around Siri AI. The hallmark feature of this upcoming 7-inch square home hub is advanced facial recognition. Unlike existing smart screens, Apple Hub can identify exactly who is looking at the screen, calculate how far away they are standing, and personalize the interface in real time. It will dynamically adjust the size of the text and automatically surface the specific user's calendars, notes, and personalized content as they walk by. I'm going to read that again. Unlike existing smart screens, Apple's Hub can identify exactly who's looking at the screen, calculate how far they are standing, and personalize the interface in real time. It will dynamically adjust the size of the text and automatically surface that specific user's calendars, notes, and personalized content as they walk by. Will people use that? I mean, I guess it could be beneficial. I mean, I have a skylight, which I love. It doesn't really turn on when it doesn't turn on when I walk by and show everything. But do you absolutely need that? I don't know. It seems like a little gimmicky. By capitalizing on Siri AI, which can securely access personal information and precisely control applications with your voice, which is where I think this is more important, Apple is banking on a level of deep personalized utility that Amazon Echo and Google's Nest simply cannot match. This is just a speaker with a screen. It is intelligent, context-aware physical assistant. But the goal, whether or not you're going to be for Apple or you're going to be for Google or Amazon, I'm a big Google fan. I think Google is going to win a lot of this because they have so much more AI infrastructure inside of your home, and the fact that they own Waymo, which means that in the future, in my opinion, Google could release self-driving cars. You could talk to Google, your Google Home device or your Google Hub that has a screen, and it can bring the car up. And my guess is that Google's going to go into this technology as well. On top of that, I mean, Google may not be able to because Apple does have a relationship with Gemini for their AI. So they're really trying to get into the AI game. The main smart hub is coming in 2 distinct flavors. The first model, code named J490, places the screen on a half dome base that looks like a HomePod Mini cut in half. The second model, J491, is designed to be magnetically mounted directly onto a wall, which is where it kind of goes into maybe even competing with skylights in some capacity, because Amazon has a Echo device that's on the wall hanging. So I am excited to see more of those types of devices and more of this infrastructure maybe competing with products like Skylight. I would like that, especially if Google had one. As for the refreshed Apple TV and HomePod Mini, internally dubbed J265 and B525, they will look identical to their current physical versions, but will pack significantly faster processors. This processing power is critical to support the heavy local computing required for Siri AI, but that extra silicon comes at a cost to the consumer. Apple has quietly raised prices on these devices to $199 for the Apple TV and $129 for the HomePod Mini, which I don't think is too, well, I guess it's kind of expensive. I guess it's not expensive to me. It might, depending on where you're at in life, those could be expensive. Looking further down the road, Apple's smart home ambitions do not stop here. The company is already developing high-end robotic versions of the hub with a 9-inch screen mounted on an active robotic limb that can physically rotate to track you during FaceTime calls. That I'm super excited about. I would love to see that. Alongside an advanced in-home security camera system to compete directly with Amazon's Ring. Okay, so it's going to have, so most of these companies, Amazon, Google, and Apple, are all going to go into your home, and they're going to try to bring AI into your home because that's the piece that was missing, which allows you to better connect all of them. And so more and more of these products are going to come out, and I'm super excited about that. And you should be super excited about it, unless you think that AI is going to destroy all of humanity. Then you might be a little turned off by it. The software, though, is ultimately bottlenecked. The smart home wave was originally slated to launch in 2024, but engineering and quality issues with Siri's upgrade, which is why they've had to get their shit together on their AI, is finally set for a public release this fall alongside iOS 27. Apple's hardware is locked and loaded, but its success in the smart home space depends entirely on whether Siri AI can actually deliver on its intelligent promises, because it hasn't in the past, and that's where Apple has struggled. If Apple can get AI right, and they can get, because they have beautiful hardware, then they could absolutely win in the space, but I'm still more leaning towards Google. We'll be right back. To wrap up today's edition of Markets Radar, we're going to talk about Ghana, Africa's top bullion producer. They have officially earmarked $5 billion, 5 billion cedis, I think is how you pronounce their currency, equivalent to roughly $429 million to directly finance domestic gold purchases. But this is far more than a simple treasury replenishment. Ghana is completely restructuring how it manages its national gold reserves. Under a newly revised 2026 budget, the government is shifting the responsibility and financing off of its massive gold mine program away from the central bank and directly onto the state's balance sheet run by the Ghana Gold Board, or as it's known is Goldbad. It is a dramatic play to stabilize the nation's economy after recovering from a crushing 2022 debt, default, and subsequent restructuring. But by shifting this responsibility, the government is introducing major new fiscal risk to its state budget. Why is Ghana shifting its highly successful gold mine program to the state budget? And does this restructuring risk throwing the country back into a debt crisis? To understand why this is happening, let's look at the International Monetary Fund. Until now, the Bank of Ghana, the country's central bank, was pre-financing the gold purchase program. The program was incredibly successful at first. By purchasing unrefined gold in local currency from small-scale miners and later selling it for foreign exchange, Ghana managed to dramatically boost its dollar supply, helping the cedi, or Kedi, gain a massive 41% against the greenback last year. But the International Monetary Fund stepped in with serious concerns. They argued that the central bank's pre-financing was essentially a quasi-fiscal activity that directly threatened the Bank of Ghana's independence. The IMF advocated strongly for the central bank to stop funding the program, so the government stepped in to fund it directly. But there is a catch. The gold bod is a financial leaky bucket. Last year, gold bod racked up massive trading losses, which actually widened the central bank's gold transaction deficit to a whopping 9 million cedis, or kedis. By absorbing this program, the government is opening up the national budget to severe financial drain. President John Mahama's administration is already projecting the country's budget deficit to rise to 2.2% of GDP this year. To keep that deficit from spinning out of control, the state is forced to slash its planned capital expenditures by 5 billion cedis. They are sacrificing long-term infrastructure investment to keep this gold purchasing machine funded. Yet, despite the fiscal tightrope, the economic payoff of this gold strategy has been undeniably real. Before Goldbad was set in 2025 to clamp down on smuggling and route artisanal gold through official channels, billions of dollars of wealth were slipping out of the country. Under the unified program, gold exports more than doubled, skyrocketing to $21 billion from just over $10 billion the year prior. That surge in bullion buying lifted Ghana's foreign exchange reserves to a historic record of 14.5 billion in February. And the impact on the ground has been dramatic. The stabilized currency helped crush inflation from a painful 23.8% in late 2024 down to just 5.3% this past June. This cooling inflation has allowed the central bank to slash interest rates from 29% down to 14%. Going forward, the mechanism changes. Instead of the central bank managing liquidity, Goldbot itself will hold regular auctions to sell dollars directly back into the domestic market, with the central bank only stepping in when intervention is absolutely necessary. So Ghana's gold for Forex loop has successfully tamed the runaway inflation, which is good because gold is utilized as a hedge for inflation, but the bill is officially coming due on the national budget. Whether the government can manage Goldbot's operational losses without sacrificing its broader economic recovery is the critical store which we will be watching. The main reason why I wanted to mention this today is because gold and physical commodities is something that all countries utilize in some aspect for their reserve, and in this case to utilize to help with specifically curbing inflation, which brings me to the point that at some point the dollar, to get it to deflate itself or to reset, it has to be pegged to something. This is talked about in Ray Dalio's the New World Order, or the Changing World Order is what I think that it's called. And so if this specifically happens, as it happens in most civilizations, the dollar needs to be devalued so it gets pegged back to something that will traditionally be gold or digital assets. And he talks about that in that book. And this is important because that means that gold should be a part of your overall investment portfolio, and so should digital assets in some capacity, specifically Bitcoin or the larger digital assets that are play here. In case there is some type of repegging to deflate, you can have access because that will cause those other digital assets, or gold in that case, to be something that's going to be utilized in the future, and over time they will continually go up. That is it for today's Market Radar. Make sure that you listen to the Age of Jeremy regular show that's about my business adventures and side quests that comes out on Wednesdays. So be on the lookout for that. And I'll be back with Markets Radar on Saturday. And as I always say, be thankful, grateful, and kind, and we'll talk with you soon. Bye.